Good afternoon, traders. Today is November the 13th, 2023, and I'm doing a very important video today as I'm unveiling my brand new trading strategy, codenamed the Unified Options Trading Strategy. That's until I can find a better name, and you can help me with that if you'd like. But I wanted to talk about this strategy today, as I alluded a few days ago that I will be doing so soon. And let me first tell you how this came about. So as most of you know, I was mostly trading 1-2-1 trade with some additional trades for a little bit of grind down protection and things of that nature. And for the most part, that worked well. I mean, we just hit all-time highs last week, so everything was fine. However, the trade itself did not perform as well as I hoped for it during the grind down markets. There was not enough grind down protection or income, if you will, for that. So I decided to go back to the drawing table. I did lots of analysis, back testing, retesting, and I think I finally have a complete trading strategy that is ready to go, and I'm starting to trade that. You can follow my path and feel free to ask any questions in the future if you have. And first of all, let me tell you that I love what I had with 1-2-1, and also what the traditional 1-1-2 or 1-1-1 does is basically you use naked puts to generate positive theta, generate that consistent income, and then you have a put debit spread, the put debit spread that's attached to that to provide a little bit of protection and a grind down income. And I like that idea of naked put and some put debit spread. I just think I was able to improve on the execution and the overall performance of the system, and even how it's implemented, because this is not really a trade. This is a system. This is a trading strategy or trading system, and it's not a single trade that you can just say, okay, this is a 1-2-1 or 1-1-2 or anything like that. This is a trading system where you basically decide what, of course, what reasonable return you would try to achieve per year, and then also you have to figure what's acceptable risks to you, and based on that, on those inputs, the system will give you the amount of weekly premium that you need to sell and then also protect. And I'll go into all the details, but it's very simple, and for the most part it can be done once per week, 1 day per week, so it doesn't take a lot of time. Obviously, for the larger accounts, you can start doing it daily, 5 times a week, 3 times a week, doesn't matter. It depends on the size of the account. But we'll start with a account of around 50,000. That will probably be one trade per week, because unlike the previous one, in this trade we're selling the larger product, the ES, or for those with portfolio margin, the SPX, and then you're buying your protection and grind down income trade or PDS in the smaller product, MES if you're on span margin, and SPY if you are in portfolio margin. Let's first talk about the big idea. What's the overarching theme here? Well, first I started by asking the question, what is the most optimal naked put that I can sell to achieve what I'm trying to achieve? And I'm not claiming that this is the best naked put for any situation, just for what I'm trying to achieve. And when I say that, I mean the ratio of drawdowns to the return, and the winning percentage, and premium capture rate, and things of that nature for what I'm trying to achieve. And let me just use this new thing that I didn't use yet, so bear with me if I make some mistake with this, but okay. So let's do this. On one side we have naked puts, and for that we need some parameters. So what I figured out that the best thing to do for me is start with the delta. So let's do delta of 8 or 0.08, but let's write down simply 8 as a best choice, most optimal choice, with a 7 and 9 being almost identical. So we can go with either one. We start looking at 8 delta, and then we can move left and right, because the important thing here to understand is we're not trying to maximize the premium sold. We're trying to sell the premium that we decided that we need to sell per week, and then move the strikes around to achieve that premium, whether it's 7, 8, or 9 delta. If we can't find that premium in the 7, 9, or 7, 8, or 9 delta, then we'll talk about that. What we can do, there are a few things we can do. The next thing is DTE, and my writing here is not that great, but it's going to take me a little bit of time to get used to it, so please just bear with me. So DTE, as a default, we're going to write down 90. You can, you can just keep maybe somewhere between 80 and 100. All of them are good, but 90 should be a default as a starting point. And if you don't have 90, you would look, maybe one above and one below, just to find what we're looking for. The next thing would be, after the delta and DTE, would be the profit take. And unlike the previous trades, and unlike most of the 112s that are out there, and similar trades where people go for 90, 95 or something, I'm going here for 60% profit target. So we're closing this trade once it shows 60%. I've tested all different kinds of profit take, and I find 60 to be optimal for what I'm trying to achieve. You're collecting less per trade once you close it. Obviously, if you close it at 60, but that's all accounted for, and don't worry, we'll get there. You're not going to be losing any money because you're not closing at 90% or anything. The next important thing would be stop loss. So stop loss is usually expressed in percentage of the premium sold. So usually people say, okay, 200% or 300%. That means you let's say if you sell it for 1 and you have a 200% stop loss, that means you're going to close it once it costs 3, which means once you get deduct the 1 that you collected in at the beginning, you're left with 2 as a loss, 2 or 2 to 1 or 200%. However, I found that for most purposes, 250% stop loss is a little bit stronger. And now I want to emphasize, it's not a big deal. You can certainly go to 200, but your overall return is slightly weaker. So it's a little bit of a trade-off. I would say if you're still in a growth stage of your account, if you're not in the income stage where you're taking money out, and you're willing to take a little bit more drawback when the market pulls back, maybe 250 would be better. If your account is large enough and you're now at a stage when you want to minimize the drawdowns but just get steady, you can look into 200. But either one we do at any stage. So I'm now structuring this at 250, and this is important, for example, because all things being equal, with 250, your win rate is going to be, a little bit, win rate is going to be, let's call it 90. It doesn't have to be exactly 90, but over a long period of time, it's going to converge around 90, where the 200% stop loss will stop you sooner, thereby producing producing more stop losses. You're probably looking somewhere in 85 to 87, roughly, somewhere in that neighborhood. Doesn't matter. Call it 86. It doesn't matter. The difference is not huge, but it is significant enough to make a difference when you're making decisions. Okay, so this is on the naked put side. And as I said, as I mentioned earlier, we are doing this in the larger instrument. So let's say ES or SPX. This doing it in a larger instrument helps you because this is a more liquid instrument, and the commissions are less, because one ES contract will cover 10 MES contracts. There's a considerable difference in commissions and also the liquidity and the number of strikes available and things like that. We're doing this in ES if we can. Now, if you have a smaller account and can't really go with the ES, well, there are a couple of things you can do. You can either, instead of doing one ES, you can go do several MES contracts. Say if you can afford only half an ES, you do 5 MES contracts instead of one ES, and that works fine until your account grows. Or if you prefer, you can do trades a little bit less often. Instead of doing it every week, maybe you can do it, every 2 weeks or a week and a half or something in between. I don't prefer that really, because doing it once a week gives you a nice distribution of your strikes over a period of time. So try to see if you can do it once per week, and until your account grows, consider doing it in MES or a SPY if you're in portfolio margin. And then let's talk about PDS. We use put debit spreads to counterbalance these naked puts, both for profit during the smaller pullbacks and for protection during the larger pullbacks when our naked puts are challenged, because obviously 10 to 15% of the times our naked puts will be challenged to the point that we have to potentially close them. And keep in mind, when that happens, that's not going to happen sporadically, because we're selling all of these in the same instrument at around the same delta. When the market pulls down, we will have more than one trade challenge. So we could be challenging all of the trades that we have open. And we have to keep that in mind when we are structuring everything. How much risk are we willing to take, and what would happen if all of our naked puts have to be closed with a stop loss? Okay, back to put debit spread. My biggest, I would say, other than doing the naked puts at 60% at 7, 8, 9 delta, my biggest revelation doing all this research was that the optimal PDS, I find that it's not the usual traditional 25 delta, 50 wide, but instead it's a 35 delta with a width of 75. Now, I know that this is going to look strange to some, and people are going to think this is expensive. You're doing 35 delta. But bear in mind, the 35 delta will, by very nature of being closer to the money, cash in more often than the 25 delta. And if you take any significantly long period for backtesting and real life trading, you will see that 35 delta with 75 wide performs much better than the 25, 50 or some other similar combinations. And not only that it performs better, but also most of the times over a long enough period of time will show at least break even or even a small profit. And this is a big deal, because for the most part, when people are doing 1-on-2 trades or similar, they consider the put debit spread pretty much gone and a drag on the account, unless occasionally they cash in on them. But if you remove the naked puts and just try to do the PDS by itself, it will show loss over a longer period of time. And that's a drag on the account. However you slice it, if the PDS is losing money on its own, it means it's dragging your performance down for the overall account. There's no two ways about it. That's just the way it is. If you do the same thing, and I forgot to mention here, this is if you're doing like a profit target at 80% of the max value. So when I say 80% of max value, that means that you're closing it regardless of how much you paid for it, because sometimes you're going to pay 17, 18, 20, whatever. You're going to pay a different price depending on the VIX and the DTE, but you want to close it at 80% of the value. So the full value would be 75 times 5, and then times 80%, and that would be your closing profit. So you're leaving 20% on the table in most cases. Now, that's not necessarily always the case. You can do a little bit of your intuition and market read if you'd like to occasionally try and close portion of the put debit spread to lock in some profits that on the market that it looks like it might pull back up and you lose everything, not everything, but you leave all the profits on the table. Or occasionally in a stronger pullback, you might decide to let it ride further to try and capture more of the available premium. But as a default, if you use 80%, you're not going to go wrong. So even if you just use 80% and stay there, you are fine. Another thing is I wanted to mention that I'm not looking at this as a single trade. Yeah, I usually will be putting them on at the same time, but there are two separate trades and I manage each one separately. And regardless of that, each one has their own profit loss and a profit target and stop loss, and they don't need to. I'm not trying to catch the market in a trap in between the two of them or something. You know, we just try to maximize the performance of each part separately, and that's it. Naturally, of course, given the structure of the put debit spread and the position, whenever the market is going down and your put debit spread, I mean your naked puts are getting challenged, obviously on the other side the put debit spreads will be showing some profit, and this is important because okay, so let me show you what we're trying to accomplish here with these two strategies running side by side. Okay, so let me try and show a little graph here and see if I can just convey my message here. So naked put campaign is generally going to go over time. It's going to go up like this, but it's not going to go straight like this. On its way up, it's going to encounter some ups and then downs, and then ups and then downs and then ups and then downs. And even though it might end up here, same like this one, you will experience lots of volatility and drawbacks and things of that nature. So this is where our put debit spread campaign is helping in, as it's building up behind the naked puts. It will naturally be losing money, going slowly down as the market is going up, but then as the market is let me see, this thing is straightening my lines, so it's going to go up as the market is going down, as some of those are cashing in. It might continue like that until the market goes up again, starts losing money, so goes like this, and then at some point market dumps big, and then the put debit spreads pick up, go like this, then market again goes up, and then the put debit spreads are losing money. So what happens is when you balance this and that, these simultaneously run strategies, you get a lot more unified equity line of your portfolio. You experience less drawbacks, even though you end up in the same place. But this is very important for many reasons, including psychological reasons, including volatility tax that happens because every time your net league goes down by a certain percentage, it takes more to get back up, and that's not really visible with the small pullbacks, like 1, 2, 3, 5%. But if you go up, if you go down something extreme, let's say 50%, well, you will need 100% to get back up. However, if you ran a unified strategy that didn't go down 50%, but only went down 10%, well, now it's not a big deal. You just need 12, 13% to get back up to your line. So this is very important and something to be mindful of. But let's go back to strategy, just so we don't lose track here. So we talked about the naked puts by themselves, and then we talked about put debit spread. Now, what we're trying to do is put the put debit spread in about the same expiration as the naked puts. However, it doesn't have to be, because they're separately managed, they don't have to be in the same expiration. We are looking for good ratio of the cost for the put debit spread versus, and I'll talk about that in a second, versus the premium naked puts and the deltas and all that. So it's perfectly fine to put the PDS in a somewhat shorter duration, not too much, but it can be, one can be at 90, 92, 3, the other one can be, the put debit spread can be at 80, and that's perfectly fine. Over time, what will happen after a few weeks are gone by, and because we're going to put a line here, and imagine here is day one, and then imagine a line that goes down, say 90. Let's see, it would be nice if this thing would now straight. It's not going to straighten. Let me try this again, a little bit straighter. All right, that'll do it. Okay, imagine this is day one, or let's call it a week one. It's easier, right? Then 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So let's keep 12, all right? So this is week 2, week 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12. So let's say we started here today. We sold one naked put, and then we bought 2 PDS and naked put, right? So in week 1, and what I forgot to mention earlier is that using the parameters above for the naked put, you will generally be able to close them within 28 to 30 days on average. Sometimes it'll take a little bit longer, and sometimes it'll be a little bit faster. But on average, it will be like a month, 28 to 30 days. When we put it on the first day, we're going to have, generally speaking, 1 naked put and 2 PDSs. And this is because the way of the structure we are spending, and I don't know if I mentioned that earlier, we are spending 20% of the collected premium on naked puts to buy PDS. So if you sell this one for 1,000, you're gonna spend 200 to buy 2 naked puts, or 1 if you're using a smaller instrument. It doesn't matter. It should be around 20%. Just also, if you're first starting, you need to build this campaign. You can spend a little bit more in your naked puts just to have a little bit more protection for the first few weeks, and you will see now why. Because if we open this one now in week 1, the next week we're gonna open another one of these, and we're gonna have 2 naked puts. We're gonna open 2 more PDSs. We'll have 4. Week after we'll have 3, and we'll have 6. So we are keeping ratio of 1 to 1. Here we're gonna get 4 and 8. However, in most cases, or better said, on average, on week 5, sell another naked put, but which should be able to close this original put. Again, it's not going to happen every time, but on average, it will happen. So we will stay at 4 naked puts, 1 new open and 1 closed. However, at the same time, we're continuing buying the put debit spreads. So we will now have 10, and we will have 4 and 12 and 4 and 14 and 4 and 16. And you can see why it's 4, because every time we close 1 here, we're going to take 1 out, right? So we're going to open 1 plus 1 minus 1. So we stay at 4 on average all the time, once the campaign gets going after week 4, after a month or so. And then at the same time, this one keeps growing because the put debit spreads were about the same expiration. Call it 90 days. It could be a little bit less. So maybe they're not going to last all the way until, 3 months, until 90 days, but, somewhere in this neighborhood. So you will slowly build it up to 18 and then 20 to 4, 20 to 4. Well, if you go all the way, it could be 24, 22 to 4 and so on. So as soon as we pass some threshold here of about a month and a half, we will have a ratio of 1 to 3. And then at some point, we will have a ratio of 1 to 4, and perhaps even 1 to 5. And the good thing about this is, because just of the very nature of how this might happen, is when the market is performing generally in an uptrend, and we're just regularly closing the naked puts and putting on the PDSs, at some point the market will turn, and all else being equal, we should be already filled up with put debit spreads here that will both protect us in the case of a stronger pullback, or provide us extra income on those put debit spreads, even if we don't have to close, because not every time that the market pulls back, you have to close your naked puts. Sometimes the market will drop down a few percentage points, stay there, and you might be able to cash in on some put debit spreads, but then the market reverses and goes back up. So this is very important. This is the power of closing the naked puts at 60 days and leaving the put debit spreads to continue to grow and mature. And the more they mature, the faster they start reacting to market pullbacks, because of gamma increasing towards the end of their life. That's fine. If they don't make any money, we just let them expire, and we just continue doing this, all the while collecting the difference in premium paid and premium collected. And I will leave some things for the next video and for the spreadsheet, and so that we can actually go dive in and take a look. But I just want to, let me just see. Okay, so we already said we're going to be selling the naked puts and then buying, spending about 20% of that premium collected to buy put debit spreads, and that will generally equal to two put debit spreads for one naked put, assuming you're doing one naked put in larger product and going with the put debit spreads in the smaller product. And this is all easily calculated, and I want to show you real quick. Let me just show here. Now, my new spreadsheet is a little bit of a work in progress, so I'm adapting everything to this new strategy. And I also, while I'm here, I just want to mention that even though I have delta and theta here, I don't want you to concern yourself with that too much, because with this strategy, I don't intend to actively manage delta or theta. Delta will naturally start positive with every trade, but as the time goes on, those put debit spreads will be building up some negative delta to offset positive delta from the naked puts. So even though we will generally have positive delta, it shouldn't get out of line, even without us managing it. And also with theta, it's the same story, and even less important for me to watch the theta, because theta can be misleading, and people then start putting on trades just because they think they have a low theta, or they start taking off trades because they think they have too much theta. And I think that's pretty unnecessary, because generally we're sellers, we're net sellers. We're collecting theta on a schedule, on a predetermined schedule, and sometimes it's not going to show on a day-to-day theta number, and it's just unnecessary to worry about that at all. So that's one thing that we do worry about is the buying power, and we just want to make sure that we are not overexposed, mainly for the purposes of avoiding margin call. So if the buying power would get out of line, then we would have to maybe either slow down or perhaps buy a temporary hedge just to reduce buying power temporarily. But that's that's a subject for another matter. That's not something that should generally be happening. But when it happens, I will show you how I will handle that. And then let me show you, this is a super simple little table here that tells you quickly how much you should be selling, and then we'll go into the platform and just actually see what that might look like in real life. You start by selecting what type of return would you like to have. So let's say 25%. I think 25% is on a higher side of a realistic return. You can go up to 30, but anything over 30, you will be exposing yourself to really larger risks, and it might be a little bit too aggressive. 25 is still aggressive, absolutely, but it is somewhat reasonable, I would say. Now you can go down to 20% if you want to be a little bit more conservative, but for myself right now, let's stick with 25%, and I put 0.25 because the formulas are then easier to work with. That's 25%. Premium capture rate, that varies with some parameters, and premium capture rate, basically, I think I mentioned earlier, just says long-term how much of the premium we sell on naked puts we should end up keeping, what percentage. Industry standard is 25. Everybody likes to use that number, and that's a good conservative number. However, I think we can get to around 28 with this particular setup. But if we can't, that's fine. Over time, that will show up, and we will then adjust it. On the other hand, if it shows higher, we can also adjust it upwards. But 28 is a pretty reasonable starting point. And the reason why it's important to put it there is because this determines how much premium you actually have to sell to achieve this goal of 25%. Now, another little thing I have here is a T-bill income. As you probably know, I think everybody who's selling options or trading options should put at least a good portion of their portfolio, say 50%, into a T-bill or a similar short-term maturity treasury ETF, or maybe even directly, depending on the broker that you use, directly into T-bills. But that will yield some income, taking a little bit of a burden off of you. Now you might decide not to count that and just keep that as a bonus that you can then spend on some hedges or whatnot. But for the purposes of this table, I wanted to put it in so that instead of calculations being done at 25%, it will be done automatically at 23%, and the 2% will be made up by T-bill. Obviously, if you have other fixed income that you know of or you can get, then you can put that number here. Down here, I put a little bit of room for yearly hedge because some people like to continuously hedge, dedicate a portion of their account value, let's say 3-5% or something, then divide it by weeks or by months, and then just continuously buy some hedges, either VIX or some puts and things like that. But if you put any number in here, it will then add on to. So T-bill will take it out, and the yearly hedge will add on to, because you have to make up for that cost. I'm not putting anything in there for right now. I don't plan to do any hedges. I think the campaign will produce enough PDSs to keep me in a safe zone. Obviously, assuming no black swan events and things of that nature. So, but if you feel more comfortable having a hedge on, you can add it, put in 0.3 or 0.03 or 5 or whatever you want, and that'll be added. Acceptable drawdown. This is a little bit more of a guesswork here, but it's somewhat reasonable. And I just wanted to give you an idea. Let's say, for example, you have to know that if you're aiming for high return, and 25% is a high return by any measure, because with 25%, you're beating the market. I mean, continuously making 25%, you're beating the market, you're beating most of the hedge funds out there and money managers. So this is pretty aggressive. But in order to get there, you have to be willing to take some drawdowns. The higher the return seeked, the higher the possible drawdown is. But let's say if you want to limit yourself to a certain number, we can do that by, let's say, if I say I don't really want to experience more than 20% drawdown in the worst of circumstances. And by worst of circumstances, I mean not the black swan event. That would be like a really bad thing, and no amount of wiggling here would stop that exceeding from that number. But here I mean by having to close all of my open naked puts with a maximum stop loss. If I want to limit myself to 20%, then I have to use the calculation to arrive at the maximum open premium at any given time. As of right now, based on my calculations, with the 250% stop loss, I believe if I have to close all of the premium that's out there, if I have to close it at a stop loss maximum at 250%, I would say 1.8x the premium sold would be the total loss, roughly, after collecting collecting profit from the PDSs. And this is where you might feel more comfortable with going with 200%, because if you change that to your stop loss to 200%, you should be able to get out with 1.3 roughly. This is a really rough estimate because we don't know how many PDSs you'll have open at that given moment, but we can use some reasonable assumptions. But definitely it's intuitive that 250% stop loss will be larger than a 200 stop loss, and I'm estimating about 1.3 in total. So if I don't want to experience a loss of more than, let's say, $18,000, then I shouldn't be selling more than $10,000 at any given time. So this is just the formula to quickly calculate that. So in my case here, I put 20%. My net leak is actually slightly higher. Let me just see. Oh no, it's yesterday I checked. It was 51. Well, it doesn't really matter. It's the same here. So In this case, the formula tells me I should be selling around $800 per week. Why? Because selling 800 per week will give me 800 times 52, give me a certain number, multiply that number by 28%, which is the premium capture rate. That will give me the projected return that I can actually keep after paying for everything, including PDSs and fees and everything like that. Let's take a look what this trade might look like. So you remember the parameters around 800, and keep in mind, this doesn't have to be exactly 800. It could be 8 and a little bit over, even slightly under. Now we're going to keep track in our spreadsheet just to make sure that over 4 weeks that we keep some type of average, but it should be roughly 800. If you go a little bit higher just to fit the parameters, that's fine as well. Okay, let's start by taking a look at the ES chain. We go to either 95 or 79. Either one will do. So let's take a look first at 95, and we can spend a little bit more time here just to see what this would look like. So let's start at 8 delta and see what we get there. So 912, that's a little bit too high. We could go, I don't mind going a little bit higher and spending 17 here. I mean, collecting 17 here because there's a higher liquidity here than down here, and we're just collecting a little bit more. And let's see if we can get 17 on this one. And if not, maybe we can do just oh yeah, good thing we wait. So we got 17. Okay, so we collected $17 and an easy shortcut. Let's go to MES. An easy shortcut to figure out how much to spend on the put debit spread is, as we said, 20% roughly. So if you know that ES is 10 times as large as MES, that means if you use the same number, 17 on 17 that we collected, if you use it on MES, that's automatically 10%. So we can do twice 17% roughly, and we'll be around where we want to be. So let's take a look if we can do that in 95 or 79 better. So we go to 35 delta, we go here 1775. We could probably, let's see, just expiration. If we go here 17, this 34 delta, it's very close to 35. If we can close this for 17 or 17 and a quarter, we would be fine. So we'll go for quantity, and we'll go for 3 of them. Remember, I said earlier that in the beginning of campaign, we can try and spend a little bit more money on put debit spreads and buy. Just a second, let me just, what did I replace it? Replace, we're gonna go up by a quarter and see if we can do that. And then we're close for 1725. And we bought 3 of them. And this is so because we don't have protection from the previous put debit spreads. We're going to spend a little bit more money first a couple of weeks just to have that extra protection that's needed there. So that's the trade. So I'm going to go ahead and record all of this in the spreadsheet. But I just wanted to give you this overview, and let me go back here. So I wanted to give you overview, and then I'm sure there will be more details to talk about as we go on. But this is the strategy in the nutshell, and I think it's very good, and I think it's gonna be good for you as well if you follow me. Now, if you found this video useful, please like it, consider subscribing, share it with somebody else. Give me some questions if you have any questions in the comments below. Thank you very much. Have a fantastic rest of the day, and I'll see you soon. Thank you.